Stock valuation is a fundamental concept in investing that allows investors to assess whether a stock is priced fairly in the market. Understanding whether a stock is overpriced or undervalued is essential for making informed decisions and maximizing returns. While the stock market can often seem unpredictable, specific valuation techniques can provide a clearer picture of a stock's potential. By analyzing various factors, investors can determine if a stock is trading at an appropriate price based on its intrinsic value and the financial performance of the company behind it. One widely used method for valuing stocks is the price-to-earnings ratio, P/E ratio. This metric compares a stock's current market price to the company's earnings per share, EPS, providing a simple measure of whether the stock is expensive or cheap relative to its earnings. A high PE ratio often indicates strong growth expectations, suggesting the stock may be overpriced. Conversely, a low PE ratio could mean the stock is undervalued or that the market has low expectations for the company. However, the PE ratio works best when considered alongside industry trends and sector averages. The price-to-book ratio, PB ratio, is another key metric. This compares a company's market value to its book value, assets minus liabilities. A PB ratio greater than 1 indicates the stock is trading above its book value, possibly signaling it is overpriced. A ratio below 1 might suggest undervaluation, but investors must investigate further to understand whether poor performance or market sentiment is influencing the valuation. The dividend discount model, DDM, is particularly useful for valuing dividend-paying stocks. It calculates a stock's present value based on expected future dividends. If the stock's market price is below this calculated value, it may be undervalued. However, the DDM assumes steady dividend growth and works best for companies with a consistent dividend history. For a more advanced approach, discounted cash flow, DCF analysis, evaluates a stock's value by estimating future free cash flows and discounting them back to their present value using a discount rate. If the stock's current price is below the discounted value, it might be undervalued. If it's above, it could be overpriced. While DCF analysis is robust, it relies on accurate cash flow projections, which can be challenging and involve subjectivity. In addition to these quantitative methods, qualitative factors also play a vital role in stock valuation. A company's competitive advantage, management quality, and market position can significantly influence its long-term potential. For instance, a company with a strong brand or proprietary technology may justify a higher price even if its financial metrics don't show immediate growth. Similarly, economic conditions and industry trends can impact valuation. A stock might seem undervalued based on financial ratios, but could face obstacles like industry shifts or regulatory changes. Market sentiment is another important consideration. Investor optimism in bullish markets can inflate stock prices, leading to overpriced stocks. In bearish markets, pessimism can push prices below their intrinsic value, making them undervalued. Factors like macroeconomic events and investor psychology often drive sentiment, causing short-term price swings. To better understand valuation, it's helpful to compare a stock to its industry peers and the broader market. This relative valuation approach evaluates whether a stock is trading at a premium or discount compared to similar companies, using metrics like PE ratio, PB ratio, and dividend yield. In summary, stock valuation is an indispensable tool for informed investing. Assessing whether a stock is overpriced or undervalued requires a mix of quantitative and qualitative analysis and an understanding of broader market dynamics. Metrics like the PE ratio, PB ratio, DDM, and DCF analysis provide valuable insights but are not foolproof. A comprehensive approach that incorporates financial data and qualitative factors offers a clearer picture of a stock's true value and its potential for future growth.